So I went back to this because lately, okay, first in the last 1 or 2 years ago, I realized that quite a few people were starting sort of circling around the same kind of ideas, and so it was a good motivation for me to force myself to try to really present and to complete what I had done at the time. So as I said, I had started around 2012. Maybe Yuri was already interning at that time, yeah. And it was a kind of natural sort of consequence of the work I had done around 2010 on super replication. So at the time I had worked already with this kind of martingale optimal transfer. And I realized that it could have a pretty much interesting application. So let's go. I can speak louder, but I cannot push my slides. Yeah, okay, wonderful. So it will be a proposition of a new way to organize the market. So it will be, as I mentioned, using some notions of super replication. And the super replication will mean different things according to the nature of the market. So super replication, so it means when can we say that that B is better than A, for instance? And so I will go through different examples here. And it will be very natural for European options. Here you just compare profile of different portfolios. It's trickier when it's American option, because if you have long short position, you may exercise some bits of it. And basically, it goes still, it essentially works. I don't think I have slides about it here, but I will try to give some extensions, actually, how it can be applied also to more complex products like path-dependent products, and how to relax, actually, this strict condition of dominance, super replication. And it leads, and this is a work I commit myself to present in the future, but it's really in progress. But basically, it's quite a general approach to statistical arbitrage in general. Okay, so let's we start with something very, very simple. So maybe it attracts attention. Maybe you will find it very embarrassing. I don't know. So let's try. You operate on a stand that sells hot dogs. Hot dogs, you need buns and sausage, one of each. So you would like to do 100 hot dogs, 100 buns, and 100 sausage. You have a market on each one. So it does it correct. No. Sorry, there's no pointer. No.
Oh, that's the top one.
Yeah, but it's what I did. And it's flipping the thing. Yeah. Well, whatever.
This one. See? This one.
Yeah.
Press and hold.
There's
a little,
press
yeah.
and hold.
Yeah.
You just do it.
Yeah.
Okay, wonderful. Thank you. Yeah, okay, so you have a 90-cent, $1 bid offer on each of the separate markets here. So if you want 100 buns and 100 sausage for your 100 hot dogs, that's quite easy. Yeah, you have to pay the ask, and so it is $100 for each. Your cost is 200. Now, you have actually other people who have an inventory because they were operating these things, and they want to get rid of it. So you want to buy your buns and sausage. They want to sell, but in different proportions, and they're not interested in selling separately. They want to get rid of everything, or proportionally at least. Yeah. So yeah, for instance, this one here we want to sell for, and so you look at the bid offer. So they would get $108 for that. Now another guy still has another inventory, and the same thing, he would sell at 90 cents each one. And eventually, so the cost will be, sorry, we would get this quantity for that. So now, X, so it was X would sell at this price on the separate markets. But he says, oh, if someone could buy all the thing for 150 for a more expensive price, I would be happy to do it. Similarly, for instance, why would you have to sell at 80? In that case, so if they combine all these offers, so not on separate markets, but on the sort of joint market, so it means that you could buy those two things here and to pay 195 instead of the 200 less than 200 you would have on the separate markets or the 100. And actually you get even more because you get 100 bucks and 105 sausage. In that case, yeah, you could then sell back the sausage if you want. But the main thing is that you have everybody is happier than on separate markets here. Sorry, you pay less than the 200 and they receive more. So, okay, this is the very simplified version of it. But so the idea is that in general on the financial markets, it's quite rare to trade one asset just. Very often it's part of a strategy. It can be pair trading, one thing against another one, rebalancing a portfolio. Then be trade the third factor of the yield curve, so a combination between futures, or it can be typically option combinations. So normally, so if you work on each market, so you have a limit order book, which is living, and sometimes back there is a trade when there's a market order. Each limit order is enriching the book. Each market order is emptying the book. But for trades where it's crucial to do it at the same time, like for instance, pair trading. So if you want to ensure simultaneity, basically you will have to cross a bid offer on each of the legs separately. So yeah, you would have something and you have to pay everything here. The idea is to find a way to cross everything jointly and actually optimizing the collective utility in some sense. So we are kind of back to the old dreams or the ambition of classical economics. And so hopefully this will see the light in some forms because it's a way to maximize the number of possible trades with collective satisfaction. So the idea is that, okay, here it is. We don't have the separate markets, so it would be actually a joint market where you leave order, sorry, it would be a joint an order book where you leave limit orders on bundles. It's called bundle, so it's a portfolio, it's a collection, so yeah, portfolio of different securities, and typically it can be a long short. So you leave orders on it, limit orders. You may convert everything into buy orders or sell orders because obviously this kind of thing. And so a limit order is a bundle with a price. Let's say we can, by convention, say an ask price. And if you leave this order, so it means that you accept it to be filled partially, provided it's prorated. So for instance, if you say, I want to buy 4A plus 2B, so you will accept to have 2A plus B, but not just the 4A, for instance. So the idea is that we will not you leave orders on bundles, but for a given bundle, you don't look for someone with the exact opposite bundle, but it can be matched by a collection of other bundles, matched or super matched, actually. So the idea is that we will look at the cheapest possible super replication, combining different other orders that are already on the market. And so it will give you, so actually a bid offer, because you can do it in both ways. So even before leaving the beauty of it is that before you leave your order, you can query, you say, okay, if I wanted to buy or sell this bundle, so what would be the price, even if it's an arbitrary coefficient and no similar bundle is existing. So another way to put it is that the current order book of the different bundles is inducing a pricing function and ask a bid on the universe of all possible bundles. So as I said, it's based on this cheapest super replication, but the notion of super replication will depend on the precise market. Here, for instance, I'm going to go through those three cases separately. If it is on a futures market, the thing is that okay, it's better to have 3 shares of Apple than 2 shares of Apple. The price of it is positive, but it's not better to be long 3 futures contracts than 2 futures contracts. They have no value. They just define different exposures. So if you want to have a precise combination of futures with different maturities, yeah, here you will have to match exactly each of the holdings. If it is stocks, it's not the case yet. What you want is to have for each of the 3 stocks here. So here, what you have is, let's say, your desired bundle in white, and in pink, it is an example of a super replication. So it means that for each of the 3, yeah, pink has to be above white. Now for options, so here we look at one underlying and one maturity. I will address the question of the calendar spread later. So you don't need to have the same holdings. And what you need, it is to have the dominance in terms of a profile. So for any possible scenario, that this is A and this is B, that B is above A. So now we focus a little bit on the stocks case, so holdings dominant. So it means it's for each one of the securities, you need to have at least as many. So slightly more formally, you have N securities here. So the bundle is a portfolio here, so identified with the vector of the holdings. And the limit order would be a bundle and the price, the ask price. For instance, we can do everything with the ask, as I said. If you want to bid it, you invert, you flip the signs. So the limit order book on this market would be a collection of those orders and which vector of weight and the price. And as I mentioned, it will induce actually an ask price for any bundles that can be dominated here. So you may have just a small number of bundles, but it induces a whole function. We'll see when you add up a new one, it will improve a whole region. So order book, the current order book can be represented by this ask function. So for an arbitrary bundle, bundle B, which would correspond typically to the one maybe you're interested in, you want to query the market to see what would be the bid and the ask here. So the ask of your bundle, which is not in the order book yet. So it will be given by this cheapest super replication. So you will minimize over the combination of existing bundles. That's why this is the condition here. You look at the portfolios of bundles, so with gamma being zero, between 0 and 1, expressing this condition of being prorated, and you want to minimize so the price of it. So you do it by linear programming, very classical and simple. And so it is the cheapest super repeating price of the bundle. Now, something which is nice is that the arbitrage condition is very simple. The question is to know if you can super replicate the empty bundle and with a negative price by some bundle, which is positive, but a negative price. So here we have to distinguish between two possibilities, continuous time and batch auctions. So in continuous times, it means the limit orders would arrive sequentially, and as the person hosting the bundle has queried the price, so they may do a market order, so to put a price to ensure immediate execution, but they would not go over that price. Actually, classical organization of the market is if there were an arbitrage, it's given back to the market. Let me just try to explain you very briefly. If on a security, for instance, let's say Sebastian is ready to buy it for 13 and Yuri to sell it at 12. If I am exterior to the market, I say, I make $1. But if you're within in a market, actually, it's not the way it works. If it happened, it would be a bit like the exchange is doing the arbitrage and gives it back. So it means ensures that the second person is executed at the available price. Okay, so in the case where it's continuous, orders arrive sequentially, you would not see an arbitrage. But if you do it in batch auctions, so it means, let's say, for instance, every minute, then you have to look at the collection that is revealed of the different orders, and typically you will have a trade if and only there is an arbitrage like that, or at least you get zero. So let's carry on. Here are some examples to understand how it works in a very minimal example, with just two securities, X and Y. So you could have different quotes here on very simple bundles. I think I go quite quickly on this. We'll see that it is inducing, again, an ask function on any possible bundle. So let's go through it. Okay, and here I basically subtract the ask price to have, so we see the difference from the linearity, so we see the convexity, otherwise everything is dwarfed by the linear component. So here, if you have two securities, and let's say on both X and Y, so it's as a classical market, a bid offer, let's say 12. So means that we have this situation. So here the axes are the holdings of X and Y. This is the price, in excess of the mid price for different combinations of bundles. And now, if I add up and add on the sum, that's 22.5. So if you did it, so it was 10, 12 on each. So the natural ask on X plus Y would have been 24. So this is better. But you see, it pushes down all this region. I mean, I just go back to the one before, like this. So again, the interesting principle is that you just have a couple of bundles being available, but again, it induces the whole function for any potential bundle that can be super replicated by the primitive ones. Now I need to carry on. I add up on the spread, for instance, I ask it here, and it still improves. So I just go back here. It does this now. And it is improving even on, even on X. Because this was the initial price, and now it becomes that one. Even if no new quotes have been done on it, but just as a byproduct of the thing, you can improve. So it's just to explain the global logic that when you feed this order book with more orders, it sort of flattens the thing that improve for potentially a collection of posters and people who would post. So now profile dominance here. So as I mentioned, typically this is the kind of thing that you'll see. We do not need to have for each of the strikes. I mean, simplest example, if you have just an option with a strike, K1 dominates a call K1 dominates a call K2 when K1 is smaller than K2 without having any comparison between the holdings. So we have this notion of dominance means that for any multiple scenarios, so it means final value of the spot price, you're above. So here, it's a typical example of what we have right here. So for different stripes of the IBM, it asked like this. And sorry, I just want to check that not split. And so if you want, for instance, call spread the kind of height one with two neighboring strikes, so it corresponds to a payoff like this. So if you look at if you want to sell it, so the bid price you would have from the market, it means you would sell at a low price the strike, and you would buy at a high price this one. So actually, you only make, you sell this full spread, you get only 0.5, 50 cents. Now, if you optimize with your linear programming, you see that actually you can widen the thing here, and you will obtain, instead of 50 cents, you have 89 cents. If you want to buy actually the call spread, if you do it the naive way, so each leg separately, so you would have to pay the high price for the low strike and not get so much for the higher strike. So you will pay 198, and with the improved one, in that case, it's a low strike that is shifted, and you will have 146 instead. So, here the summary. So it's the improvement of the bid offer. It was 50 cents and $1.98 and 89 cents and 146 as an example. So you see the super replication and the sub replication, and it is really with a real market data. It's not an illustration to convey a concept. Here, it's a kind of difficult for different call spreads of neighboring strikes and as compared to the low strikes, and like that, you see the improvements you can get. So the improved ones are the orange and green compared to the naive ones. Another example, for instance, SPX S&P 500 options. If we want to, it's even more striking here. You want to have to buy a butterfly, and I really am not talking about fancy combinations. I am the kind of most common. So here, so if you first of all, if you have something like that, there will be nothing you can do in terms of the bid and you can not do something better than zero. So we'll pay more attention to the ask. So it means you want to buy this, and we look at the naive price, executing each leg, and the LP solution. So in that case, again, yeah, so you have to buy one of this, sell two of that one, and buy the other one. And so the combination gives you 480. And when the optimized one, actually, it's much cheaper, about half the price, 255. And interestingly, it's not just shifting this strike by one level, but by two levels. And on the way up, by three levels. So it's not necessarily symmetric. It's just the LP is finding the best combination of those. So you will say, yes, because yeah, individual ones may be more expensive, but basically when you super replicate with lower slopes, it means you need less of each option, basically less of bid offer crossing. Yeah, that's the summary here. Minimal exercise. Well, I don't know how much time I will spend on it because maybe it's a bit obscure for quite a lot of people, but the question will be to see whether something that works clearly for European option, because what matters is just to dominate the payoff, the final payoff. How does it work with American options that can be exercised before and you don't have the control? So, yeah, but we carry on for the time being with one stop and one maturity. So dominance in the European sense. So it means that you would have, for instance, 4105 dominated by 4100. So it's a very simple example of again, dominance of the profile at the end, even if there is no dominance of the holdings. And how do we check that A is dominated by B, for instance? It's very simple because it's just two piecewise linear profiles. So you just have to check that at the union of the breakpoints, B is above A, and the slopes is dominated to ensure that it doesn't cross further away. But now, American option dominance. What does it mean that A is dominated by B if A and B are portfolio of American options? So basically, it means that if you wanted A, you should be, you would be happier with B. You know, it may involve having something to do with delta hedge, whatever, but it is rationally preferable to accept B. Or another way to put it is if you sold A and you buy B as a hedge, yeah, you manage to do something in such a way you're always winning. So I have a lemma here, which is that if A and B are long-only portfolios of American type options, so if A1, yeah, sorry, yeah, okay, and A is dominated by B in the European sense, so in terms of the final profile. Now, question, can we say that A is dominated by B in the American sense? So it means knowing that it can be exercised early. So the idea, so actually what we have to show, it is that if, yeah, for instance, in the logic where you sold A and you buy B as a hedge, and everything is long only, then you have to make sure that whatever Mr. A is exercising, it exercises part of this portfolio, let's call it A1, then you find a way to exercise part of B1 here, that dominates nearly, so intrinsic value you have to pay here is covered by the one you get. But on top of it, what remains still has to dominate. So it's in this sense, I call it the minimum exercise. If you manage to do it, so by induction or whatever A is doing, yeah, you respond and until the end. So yeah, this lemma here tells you the consequence of this lemma is that if A is dominated by B in terms of profile, then A is dominated by B in terms of preference. Yeah, you prefer B to A. You have to work a little bit to show this this lemma. Actually, it is linked. Okay, you have a first and second order conditions, but essentially it's linked to the dominance, the ordering. Sorry, the dominance in the convex order of the second derivative of the payoff. And it tells you, okay, so I don't know if we can. Sorry. But, and some pieces of chalk here, you see. Now, because you've seen the, if I managed to do that. This is the symbol of the Field Institute. Yeah, you've seen. Yeah. Okay, essentially, I mean, I just show it in a very simple case. It can be an easy interview question. So you know that for European options, and I'm not going to ask you because no embarrassment. Now, okay, so you know that for European options, the price of the call as a function of the strike is obviously positive, decreasing, convex, with initial slope greater than -1. Yeah. But it's convex. Question, is it the same thing for American option? The price of American option as a function of the strike, is it convex? Yeah, it's yes, because it's still the same thing. If you have, let's say, K1, K2, and K3, so basically you have this domination, which is zero. So again, if you sold thank you, you sold this one here, and you hedge by having the rest. So if the buyer here exercises, then you can immediately exercise the other one. Yeah. So it means you have this, and which means that the prices, American prices of them, has to be satisfied. Yeah. Another way to put it here is to say that, okay, if so this is K2. If I look at the second derivative, so I have Dirac masses here. Okay, this is the left-hand side. Well, it's no color, but it's okay. And the right-hand side, so here it's half of this one. I put in dotted lines here, and a half of that one here. So the logic, if part of it is exercised, actually, then you will have to eat up part of the, part of this and part of that. If you exercise here, it will be mimicked there. And if you had a situation like this, actually, here the dotted line here, and this one, something not necessarily symmetric here, and the other one was that. You have conditions on the barycenter and the masses, but yeah, typically this would, if you start exercising this one, then it would correspond to something prorated here. And actually, if you carry on and you eat up everything here, then you have to carry on to to other levels here. So basically, it is cleaning the closest one and propagating. A bit like an order book, actually, yeah. Okay, this is the very vaguely the logic. Thank you. And so this was showing that if it's long only, it works. And after it's a couple of tricks when it is long short position. So basically now you assume that A is replaced by A minus A prime. A and A prime are long, so it's a long and the longer component and the short component. Same thing for B. So we would like to show that all options are American type, that if again, you have a dominance in terms of profile, then you have a strategy to be protected. So for instance, if you sold the left-hand side and you buy the left-hand side, you can do that. So essentially, first, you use the fact that, so the premise here was this. If it's European option, it's very easy. Everything is linear. You can move things around. Sorry, here. And you do this, and now everything is long only. You can apply the lemma. And so as this telling you that European type dominance implies American type dominance here. And after, so what you do, you start again from here, and you add up a sort of a neutralized position here that can be interpreted as posting two opposite orders at the same price at the same time. And you rearrange you have this here, and now so if on the left hand side, so basically if you were happy, if you were okay to short A prime here, which is here as well, so it means that if you show that A is dominated by B plus A prime minus B prime, you will be down. And why is it good thing? It is okay. Why do we have this? It is okay. You have to check two situations that we do not control. One is that the left-hand side is exercising A, or that your position, which has a minus B prime, the B prime is exercised as well. But then we are back, yeah, due to what we had here. Yeah, if either A or B prime or part of them are exercised, you know what to do on the other side. So you cover those two. Right. You cover those two situations of having either A or B prime being exercised. So yeah, it's a bit slightly painful, this example, but it's step by step to show if you, for instance, if you wanted to have the blue profile, and instead you find a cheaper yellow profile, so what you have to do exactly in each cases. But I mean, those things are trivial, but by experience, I know it's painful to follow. But basically, yeah, it tells you what you should do at each step, and then maps back to the classical thing that I have shown before. Yeah, okay, so I think let's skip that. But so it works very nicely. The European type dominance in terms of profile imposes the American type dominance for whichever exercise strategy, but there are limitations actually. One is with respect to maturity. I will explain this a little bit. And surprisingly, in some sense, you cannot mix calls and puts. You cannot mix European and American option. Actually, you cannot have constant zero coupon. A zero coupon is of European nature, because they were early on. I thought, no, but it's odd those results, because maybe there is a counterexample with some put call conversion and so on. But no, it works provided you don't mix them. So about maturity, another quiz here. Interest rates. So we are dealing with the calendar spread arbitrage. So if interest rates are zero today, so the yield curve today is zero for all maturities, no carry terms, so it means no dividend, no repo, and sorry, no bid offer, and no short sale restriction. So if for a same strike, A, you have the T2 maturity call cheaper than T1, the T2 is after T1, is there an arbitrage? Okay, maybe this one I ask, yeah. Yes? No, not necessarily, because here I said that interest rates are zero today. I've not said that in the future it will be. What matters? Yeah. Now, I try to say today, I emphasize that, yeah. Okay, so the thing is that to implement this thing, typically, I mean, if interest rates are zero forever, it is, the classical thing. So let's say I sell you the T1, I buy the T2 as a protection. So if at T1 it's out of the money, I'm happy because then my short position is worthless, I can just long. And if it is in the money, then I sell the stock and I convert the call it into a put. But basically at no cost. If you have interest rates, you have a cost for the conversion. So if you have a model where, for instance, at T1, if you're in the money, the interest rates are negative and positive if you're out of the money, in such a way that the yield curve was zero today, and volatility is very low between T1 and T2, actually it violates the arbitrage. So we did it to build a little model that really was satisfying all this, and it's no problem. Still, if you're okay, so what does it mean? It means, and many people are confused about it because the strike arbitrage is a strict one, right? And the calendar arbitrage calendar time arbitrage is model dependent in some sense. But if you have interest rate options like call option on the discount factor, in that case, actually, you can super replicate so that you can lock it in. But it's a bit complicated, but okay, it means that if you had all that, you could expand these ideas here of super replication across maturities as well. Yeah, sorry, that was the explanation, that the practical thing with no interest rates. And yeah, but so yes, that is, you have a problem, and still with interest options be allowed. Yeah, before I prefer to make some comments before the conclusion. So it's two types of comments. One is that you can expand this notion of dominance to still other markets, like for instance, path-dependent options. The idea of dominance, it is to define a set of scenarios, ideally all possible scenarios, to verifying that A is dominated by B pointwise for each one of them. So if you do it for path-dependent option on a rich enough set of scenarios of paths, you will have almost surely, naive sense, not probabilistic sense, dominance. And anyway, if you don't have full dominance, maybe you will still be happy to have a clearly advantageous deal, which is exactly what we do in statistical arbitrage. So actually, I went back through quite a few different things of volatility arbitrage. For instance, if VIX was instantaneous and not over 30 days, yeah, there are strict conditions between the VIX options and the S&P options. And it's not a direct a trivial one, but if you put all those instruments into the LP smartly, it finds what to buy and what to sell. We've been expanding this to many different situations to retrieve actually the different dominance properties or classical statistical arbitrage. So it's you can open the thing in quite a few different ways. So before I'm interrupted, so again, hopefully, so this proposition of organizing the market in a different way and more collective one would achieve this goal of improving the global social utility, again, to try to contribute a little bit in all the classical tradition. But what we've seen, so here, you have this notion of dominance depends on the different markets. And what is important is that, so again, the goal is very ambitious to have exchanges changing the way they do what they do, even if they start doing this. You have now many prepackaged bundles, typically tight call spreads, the food spreads on the S&P, but still it's very limited. And here the idea is not to have more predefined things, but to combine them for flexibility. So one thing is this global market organization that is out of our control, or maybe it's this kind of gathering that make ideas emerge and maybe gather some pressure to I don't know, to team up with exchanges. But the second thing, it was in the specific case of the option combinations. You don't need to change anything. If as a customer, as a trader, you wanted to buy something, you can just apply your little LP to find something more advantageous. And it's really happening with market data. I didn't cherry pick to find something especially favorable. So, okay, I hope you enjoyed the journey. Thank you for your attention.